Hey guys, welcome to another episode of Make Money Count. Today, I'm sitting here with Marcus.
Hi, Justin.
And today we have a very special guest. He is head of underwriting for Cannect, and his name is Phil Edwards. How you guys doing?
LA.
We're good.
All right. It's great to have you on here.
It's good to be here.
Yeah,
I don't know why you've been so reluctant to come on for so long.
I like to stay in the background. I'm not like the forefront type of guy. I like to, have my present felt in the background. One of my roles is like
To be a buzzkill?
yeah, and being the mature one. And when things go way too left, center everybody back in.
Huh.
That's true. I like that.
Really?
Yeah.
I thought it was just that you were moody.
Some might say so. I don't know. Just
Not me. No, that's not me that's saying it. It's
everybody else.
I don't say that.
Somebody
I
who
don't say
rhymes
that.
just Rustin.
Yeah, no, I don't say that. I don't say that.
it's not Justin Turner necessarily that would have said that.
I love working in the office with Phil. It makes me happy. Phil makes me happy.
Oh my God.
We gotta, yeah. It's
what's
really
funny? Is what a departure that is from what you usually say to me.
Oh my God.
Spill the tea.
Yeah.
Okay.
Tell us all about it, JT.
Back on track. Today, we're going to be talking about, obviously, we're going to get a little bit of an update on the market from Marcus. And we're going to be talking about, a lot of people right now, they're coming up for renewal. They don't know what to do. Their mortgage rate is going up exponentially. They maybe can't afford their payments. And so we'll talk about some options. So, Marcus,
Yes, Justin, talk to me.
other than the downfall of my favorite stock, what is
Affirm,
happening?
Hammered.
Yeah.
So you understand that, like, as much as we joke about Affirm, it is, it's kind of like the proverbial canary in the coal mine for the economy,
Right.
because Affirm is a specialist in this kind of buy here, pay here financing.
Buy now, pay later.
Well, yeah, I think they call it buy now, pay here, or buy here, pay here, or regardless.
They
it's-
definitely call it buy now, pay later. I am a majority stockholder in a firm.
Okay.
No, I'm just joking.
So the whole idea behind Affirm is that you can divide up the payments for anything. Like you could buy, like I bought you guys those sandwiches today, those banh mi sandwiches.
Yeah.
Those banh mi sandwiches, you could literally like divide the payment up into 12 payments.
Right.
So the problem with that is it's like the last piece of credit, which is like the least secured, the least thought of, the most risky. And they were doing something very similar to what the banks were doing during the subprime mortgage crisis, right? Like they syndicate and securitize that debt and they chop it up into positions and they sell it off. And the guy that has the last piece makes the most and the guy that has the first piece makes the least. But it's this kind of false sense of security because all of it is shit.
Right.
It's all garbage. Anyways, so Affirm in a time period when interest rates are extremely low and there is a huge amount of capital available for this type of lending, and the consumer is relatively healthy because they're not servicing a lot of their debt with high interest rates, that business model works really well, right? Leveraged finance.
Right.
But in a market where interest rates shoot up and the risk premium associated with lending money into that tranche of capital increases to the degree that it has, well, then the market doesn't work as well. And not only that, the borrower can't afford it.
Right.
And the first thing the borrower will stop payment on is the 39 cents a month he needs to pay to finance the banh mi sandwich he had January 11th. Right?
Yeah.
Anyways.
It's hard to pay for things after you've received them too.
Yeah.
And if you're in the psychology of these borrowers who are using this, I think, you know what I mean?
Yeah. So the reason why it's funny, like we talk about Affirm, is that Affirm, is the kind of low-hanging fruit of the credit that's going to get screwed with.
Right.
But what's happening in the market, like specifically, I was looking at some great numbers. The Toronto real estate market is showing great resiliency. Like prices have the market's tightened. A lot of homes are going with multiple offers over a listing price. Like I don't know, that obviously is going to get impacted as this additional supply hits the market. But I think like adding to the fact that like the Bank of Canada has now yet again made an emphatic statement that they're not going to increase rates, right? Like it seems like this Bank of Canada governor, it loves emphatic statements. Like first he told us interest rates are going to be very low for a very long time, so feel good about borrowing money. Now he's telling us interest rates aren't going to go up anymore. Like it's all Fed speak. It's all like central bank talk. But
So do you think they're going to continue to go up?
So it's a great question considering today we got Canadian employment numbers out, and they were way hotter than expected. So that, like, the problem is the labor market. We talk about that a lot, right? Like the labor utilization is so high that it's an issue, and the bank is definitely concerned with it as far as leading to inflation, right?
To be clear, the less people that are unemployed, the worse off for our market, or for interest rates coming down, anyways.
Yeah, exactly. So, I think part of this is that people left the workforce,
right?
So they're not even counted in that unemployed rate, right? So the number of people unemployed shrunk because the number of people that moved from being job-seeking unemployed people to non-job-seeking unemployed people, once they become non-job-seeking and they are no longer counted in that unemployed labor contingent. So like they're no longer counted in that, which means that there are fewer people to pick from to give jobs to.
Right.
We want to increase the number of people that can be picked from to give jobs to.
Right.
And we're not seeing that, right? Like we're seeing that, labor is getting sopped up into the economy at a very quick pace right now. And that is an issue for a central bank that's trying to fight inflation. So I think that, and the Bank of Canada is aware of the impacts on the housing market and on consumer debt. So listen, it's all probabilities, right? Because it's like, what will the next action be? Right now, the Bank of Canada is telling us that they're not going to change interest rates, and we're going to stay where we are for a period of time so we can tamp down inflation. If that is the case, and the unemployment rate increases as predicted, it's likely that we won't see much more of a downturn on housing prices. But these things are changing, right? They're kind of constantly changing. So,
right.
I think we probably still have a little more pain in the real estate market. I don't know when it's going to happen. But still, like these rates are high. They're high for everybody. People weren't anticipating them. So that's why, like today, that's why we got the hired guns out here, Phil, tonight, to tell us about some of the solutions that are available to people if they're having a hard time managing their payment, right?
Mm-hmm.
Like people's payment went from being calculated off a 1% rate to a 6% rate. Like that is a real thing, right? Like if you had a variable rate mortgage at prime minus 90, you went from 1 to 6. Crazy, right? I mean, pretty close to that.
Yeah, it is pretty wild. I'm speaking to a lot of people who have that exact question of like, what am I going to do when I'm renewing my mortgage right now. My mortgage rate was 2%, and now it's especially with some of these like B lenders and stuff like that. Depending on who you're with. I mean, some of these B lenders are renewing at 8.5%. It's crazy.
Yeah, it's ugly.
Yeah.
So what's the solution, Phil? Can you tell us?
Yeah, I mean, sorry. I think the biggest piece of advice that I could give is start the conversation, right? You can't really expect to have anything change if you don't at least ask the question, like, what can I do to better my interest rate, right? So, I know you have a lot of conversations, Justin's, with clients where they're saying, this is unsustainable, right? I can't afford this next payment. that's a great place to start. Is if you think that you can't manage that payment, have that conversation. What we've been finding from lenders is that there are options that are available to lower the payment. Number one, we can always look to see if there's another lender that's out there, right? The first place to start, basically, is just seeing, like, is there another option to get you a better rate? Because there are the lenders, if that's the lender that you may be with, or the category of lender that you might be in, where we can find specials that are out there that are lower than 8.5%.
Definitely.
Right? Like, we have some lenders at like 4.99%, 5.99%. That can be a significant savings to you. And if we get you in there with that lender, then amazing, right? That's immediate savings for you. There are other options, like if we can't move your mortgage, looking to see if we can re-amortize your loan back to the original amortization or higher to get your payments down. And not even in the B lender space, like even in the A lender space, like lenders in general kind of understand the pain that people are going through. So there still are options. They may not be advertised, but, as your mortgage broker, which, having that conversation, going back to that, have it with a mortgage broker that you trust. Ideally, give us a call. But, we know of some things that lenders are doing, like especially if you're in a variable rate mortgage. Some lenders are allowing you to re-amortize your mortgage up to even 40 years if you can demonstrate that you are in, some financial.
That's a good point.
hardship,
So
right?
that a lot of people don't consider that, but the lenders aren't advertising the solutions,
No, yeah.
right? Like during COVID, they advertised the solutions. Those same solutions are available now, but they're not telling everybody about them, because the more people that utilize those solutions, the worse it will look on the performance of their entire loan book, thereby affecting their share price, right? So they don't want to say that they're giving workarounds and remedies to more people than they absolutely have to. But you can definitely, when armed with the information, so if you are sitting out there and you're in a variable rate product and your rate has gone from 1 to 6, well, you can have a conversation with one of our agents, arm yourselves with the information, and then go back to your bank. I mean, we can speak to them on your behalf, but I can understand, like, you want to have that conversation on your own. We're more than happy to arm you with the tools that you need in order to have that conversation.
Yeah. You just need someone on your side.
I think that's critical, right? Like the whole thing about Cannect, sound, unbiased mortgage advice. We want to give you the information. We're pretty confident that afterwards you're going to want to do something with us. But the first step is probably to have a conversation with your lender. We can do that for you, or you can do that on your own.
I actually had a conversation with a client yesterday. They had gone to their bank, RBC, and they had gone to CIBC. And because of like a collateral mortgage on their property and this and that, they weren't able to do what their banks had promised them. And it took me, and it should take any licensed mortgage broker or agent, 5 minutes to figure this out. You know what I mean? Where they had been waiting for the banks for weeks, right? So the bank's not always your friend. You know what I mean? So
They don't know also sometimes, right? Like,
yeah.
the person you're dealing with at the bank might not know the entire suite of solutions that are available, right? Like, you just phoned into your bank. You spoke to one person. Again, we talked about this before. They're not necessarily licensed to trade in mortgages. They don't have to be. They don't have to have that level of knowledge. You're not necessarily getting all of the answers. You're not getting the full suite of products that are available to you. Whereas you call, I mean, I would say, like, if they got Phil on the phone, they would probably get a lot more information than if they called you.
All right. So I got a question here. And if you are watching us on YouTube, I have buttoned up my cardigan since the last cut. So just so you know. All right. So, hey, Marcus, I got a variable rate mortgage last year. This one's specifically for you, so no one else is allowed to answer. I got a variable rate mortgage last year, and since then, my payments have doubled. My mortgage balance is about $350,000, and I have quite a bit of equity in my house. My realtor said it was worth probably about $1 million. I'm getting to the point where I can't afford my mortgage payments, and this is really affecting my day-to-day life. I'm not sure what I can do or how much longer I can survive. What would my options be, and am I stuck?
All of these decisions kind of come down to timeline and intention. Like, so like right now, if that property's in Toronto, values aren't that far off the high.
Right.
There's not a ton of supply. Like a lot of this talk of like the market's collapsing, there's blood in the streets. If it's a good product in a good neighborhood, it has not come off that much.
Mm-hmm.
Not yet anyways. So whatever, like this person has a ton of equity, right?
Mm-hmm.
350 on, it's $1 million. If it's a condo, it's in Toronto. Unlikely that it is a house in Toronto. Maybe it's a row house, you know, it's unlikely that it's a house in Toronto.
Right.
But they have a significant amount of equity that they can use. So the question now is, like, for me, okay, I have a family, young kids in my house. It is, Phil, same thing. Like, it's very disruptive to sell my house and move into a rental. It's also expensive, right? So like people need to consider that when they're going through this decision-making process. Like it's all fine to say property values are going to drop another 10%. Let's say worst case scenario, property values drop 15% from here. Let's map this out. So over the course of the next 12 months, property values are going to drop 15%. And you know this. It is written. Okay? The worst case scenario will play out. We're going to see a 15% drop. It'll look way worse because in the middle of the drop, people will be like, oh my God, it's going to drop 50. But it's very, very, very unlikely that the values of properties will drop more than 15%. Okay, let's crystallize that. And let's try to make a decision against it. Right now, for the next 12 months, okay, is what the bond market is telling us. So for the next 12 months, rates are going to stay elevated. So our friend here who has a $350,000 mortgage on $1 million property, if he sells now, he will pay the real estate commissions for the sale, $50,000. He will pay an expense to leave his current residence and move into a new residence, $10,000. He will pay first and last month's rent on a spot that he needs to rent. We have to assume it's going to be relatively equal to the place that he was currently living. He's living in right now. What is that? $5,000 a month?
I was going to say 3,500, but
for $1 million condo,
Rents are up, so
rents are up significantly. So say $3,500. Fine. First and last, $7,000. Let's just say 10. We're at $70,000, 7% of the value of the home to move. Add on to that, whatever the psychological, emotional expense of making that move is. There's a reason why when you give advice on buying a home, you say, like, this is a long-term investment, right? Like when you buy it, you need to anticipate that there will be price shocks, which is why the stress test was brought in, which is why a good mortgage broker will discuss affordability with you when you buy a house. We get it though, right? Like unforeseen things happen. Like who would have ever anticipated rates were going to go up from 1 to 6? Who would ever anticipate that this level of upheaval would happen in the marketplace? And it's unfortunate, and it sucks for a lot of people that need to manage these payments. But for whoever this person is with $350,000 mortgage and $1 million valuation, I would definitely use one of the solutions available. And I would say there's probably 3 main solutions, right? The first thing that I would try to do is I would try to increase the amortization on my variable rate product. I try to blow it out to as long as I could to mitigate the impact of the debt servicing payments. Because the cheapest way to service debt is to utilize that first mortgage, right? That first mortgage, even though it's a variable rate and it's probably like 5.5% to 6%, because it's a point to 50 basis points below prime. So it's still high, but any other alternative will be more expensive. So if available, the first stop in your quest to solve this problem needs to be extending the amortization of the existing loan because it's the cheapest money.
Mhm.
Failing that, like assuming it's a B lender or it's somebody that isn't willing to be as helpful, you need to figure out whether you're going to switch that first mortgage out for a new first mortgage where the lender can be more amenable to those changes, or you're going to borrow a home equity loan. With the amount of equity that this borrower has, that home equity loan is not going to be very expensive. The one thing that I've noticed in the marketplace, home equity loans haven't really increased in rate commensurately with the rest of the market.
Mhm.
Like you can still get a second mortgage at 8%. 8% is like prime plus 130,
Mhm.
right? Prime 6.7.
6.7.
Yeah. Prime plus 130 on a second mortgage if it's a good product. So there are a lot of options. I would say like the biggest pitfall anybody ever makes in this business is they assume they're going to need the money for less time than they do.
Mhm.
Just take it for longer and don't stress about it. Right? So like in this case, whatever that dollar amount is to mitigate the damage that those payments are doing, you're going to erode your equity, right? Like it's got to be expected that you're going to erode your equity. But you're also kind of playing with the delta between the cost associated with you selling and moving right now and the cost associated with servicing the debt that you need in order to stay inside of the place that you're in. There's nothing to say even about going forward. You're going to have to go and buy another place.
Yeah.
Conceivably, you will want to re-enter the marketplace. And unfortunately, the time that you will want to re-enter the marketplace will be when interest rates are lower and when property values are higher again.
Mm-hmm.
So it's like buy high, having sold low. I mean, that's your investment philosophy, but like it doesn't work for many.
The money that you would have spent to sell your home and move, you're going to be paying a realtor. You're going to be paying someone else's mortgage when you rent a property, right? None of that money is reinvested into yourself. Whereas if you're staying in your property and you're paying down your mortgage, you're at least kind of, again, with that money you've borrowed, chipping away at the principal on your first.
What we're talking about right now is a person who's deciding on how much of their equity they're going to need to utilize to stay in the house.
Right.
So it's still an expense.
Right.
Like
right.
on the income statement, this is an expense. It is the cost to service the debt, to maintain, to hold on to the asset for 12, 18 months to weather the storm. So either way, you're not investing it in yourself. You're not investing in your property. You're utilizing a chunk of your asset to spend in order to maintain it. So I get what you're saying. I'm just trying to compare it to the cost of the thing, right?
Yeah,
So like, what's the cost? The cost for this guy, let's say he needs $100,000 and it's going to cost him 8%.
Mm-hmm.
It's $8,000 to borrow the 100, right?
Mm-hmm.
In addition, the 100 is going to be used to service the 350.
Mm-hmm.
It's a bit of a worst case scenario because like the 350 conceivably is at what, 6%, we said?
Mm-hmm.
So it's $20,000, right? $20,500. So like the $20,000 is the total of the interest expense associated with that first mortgage for a 1-year term, less what he was paying something before. But let's say it was 1%. So total new expense associated with this mortgage as interest rates have increased, $17,500. Right?
Yeah.
So if we're just trying to maintain this home, the real cost of holding onto this home for 2 years, we can kind of all agree that in 2 years, interest rates will have fallen back. Things will have stabilized. I mean, we can agree to whatever, but like, that's where I believe myself that whatever we're going through, values will come down a little more, then rates will come down. It does, however, it seems to be taking a little longer, right? Like the jobs number came out. It was really good still. It's taking a little longer. And the fact that it's taking a little longer either means that we may have some secret strength within our economy that seems to be kind of holding on. And maybe it can continue to hold on through the cycle after inflation comes down, and then we can naturally reduce rates without having inflicted too much damage on our economy. I don't believe that that's the case. I don't believe it's the case. I believe all we're seeing is a slower reaction time to the increased interest rates. And that slower reaction time than what has been anticipated by the market might simply just be pushing out the length of time for which we need to be enduring the high interest rates. So let's say it's the 2-year mark, okay? And the 2-year mark, we're talking about like a process by which we can conservatively estimate to be interest rates staying at a high level, coming back down, and then renormalizing our real estate market for this borrower. 2 years. 2 years at an interest rate that's 5% higher than what it used to be. 2 years, $35,000, right? 5 percentage points, $350,000 mortgage. 1 year, 2 year, 35 grand. Plus, he needs to borrow that 35 grand. Let's say there's other debts. Let's make it 50 grand that he's going to borrow at 8% now in second. But we can do that deal, right?
Yeah.
So then there's another $4,000. $54,000 is the expense to normalize the timeline for the next 2 years, insulate this borrower. So the cost is $54,000 versus selling the home right now and having to re-enter the market 2 years from now when we kind of agree values are going to be stabilized, if not higher.
You know, I was going to say that exact same thing. You took the words right out of my mouth.
Yeah,
that math.
Just in a different order.
Yeah. Next question. All right. Hey, guys. I'm coming up for renewal within the next few months, and I just got my renewal offers. The rates are horrible, but I don't know where else to look. Is there something else I can do to help myself get a better rate? Is it possible to transfer my mortgage somewhere else? I mean, that's a pretty simple one.
Simple. So does that mean you want to field it?
I can field it.
Hey, Phil, you know what I like to do while he's answering his questions? Just in my head, think about all the mistakes he's making.
Oh, God. God, that's so mean. You know I'm the principal broker, right?
Yeah.
Yeah. Okay. So, I mean, listen, if your mortgage is coming up for renewal, rates have gone up, you're worried about what you're going to do. It's a very common thing right now. It's pretty much everybody that's coming up for renewal. So, you know, what I would say is, Marcus is making funny faces at me. What I would say is just, you know, like Phil said earlier, which I think encompassed is such a beautiful thing, right? Is get everything started early. Like reach out, because that's the first step, right? That's
Start the conversation.
Start the conversation. That's what you said. When you go to your bank, if you're coming up for renewal with your bank, you know, I tell clients all the time that when you come up for renewal with your bank is going to offer your bank's rate, right? You're going to have one product and one box to fit in. Perhaps you don't even fit in that box anymore. So, you know, you need to figure out another solution, and coming to a mortgage broker, a mortgage agent is going to be the best decision you make at that stage, right? Like Marcus says a lot, it doesn't have to be Connect, but it would be nice if it could be Connect. Reaching out to a mortgage broker or mortgage agent is the only thing that you should do at this point, right? So
that was really well answered.
Yeah.
Yeah.
I would add that, especially.
Oh,
not trying to steal your
No. This is why you're here. Different perspectives. I like it.
Add a little bit more value to that, but like, especially on transfers from mortgage lender to mortgage lender coming up for maturity, maybe not. Like there are deeper discounted rates when you're just moving your mortgage. You don't need to borrow additional money, so there may be some aggressive interest rates that person would be have available to them if they give us a call, because we would have access to those interest rates for them. So that would be one thing for sure. Start that conversation with a mortgage broker, ideally Connect, where we can look at what those transfer rates may be for you. Right? Those are typically like insurable products that we call some underwriter speak, that are basically like really discounted interest rates, because those are mortgages that are backed by an insurer. Because that kind of like saves money for the lender. They can in turn offer like more discounted interest rates to their clients, right? So especially if you're up for renewal, those are options that like we look at as mortgage agents to kind of move those clients into essentially, right? So yeah, 100%. Give us a call, give a mortgage agent a call, start that conversation so we can look at some of those transfer rates for you if you're up for maturity and you don't know what to do and you're worried about like your rates kind of doubling or your payments doubling because obviously we are rates are really high right now.
I had a client come in the office earlier. They were coming up for renewal with their bank.
Yeah,
it may or may not have been Meridian, and they were offering them the variable rate that they offered them was prime. They were like, my bank's offering me 6.7 for a variable rate. Is that good? And I was like, no, it's
for
terrible.
Your bank.
Yeah, exactly. It's good for your bank. Yeah. So, and a lot of the problem is a lot of the people, they just sign it back, right?
That's
the
thing. Yeah. Like the bank is hoping, crossing their fingers and just hoping that you just sign the renewal that you're offering, right? That you're not going to start that conversation or pick up the phone to say, what can you do better than this? So they're not going to put their best foot forward, right? As mortgage brokers, mortgage agents, like that's our job is to always put our best foot forward because our interests are aligned, right? Like we want to save you guys money on your mortgage. That obviously, gets us paid as mortgage brokers. And we have, really discounted interest rates that, we can offer our clients to help save them money. So in the end, our interests are aligned, mortgage brokers, clients, as opposed to, working with your bank who is just essentially kind of hoping that you, in a way, get screwed over, right? By just taking whatever they tell you is a decent interest rate.
I'm confident that that person, when I do pull their credit, also has their credit card with them and their line of credit with them.
With Meridian.
And their car loan with them.
And you've heard that rates are high. So like when you see a high rate on your renewal, you're probably just going to be like, okay,
I'll take
rates are high. I'll just take it. But you can have the conversation and ask the question, like, is there something that you can do better than this? Have that with your bank and then call a mortgage broker, call Cannect, see what we can do that can better that offer. Maybe we can speak to your bank because we do work with most of the major banks. And we can probably better that offer that you've been given, right?
And if you don't like me, because Marcus makes fun of me all the time, Phil's always available as well.
Everybody likes you.
They do like me.
Yeah.
All right. So hey Phil. Things are a bit rocky right now, and I'm in need of some financing. I have a 5-year fixed mortgage at 1.99% at $400,000. My mortgage matures in the middle of 2025. My property is worth about $1 million. A lot of 1 millions around here.
I think it's just people like
it's just
shoot it out there.
And I only need about 150 to do some upgrades to my property and pay out my debt. I don't really want to lose my rate. Are there any suggestions that you have?
Yeah, I mean, I feel like you guys have answered similar questions in the past on the podcast, especially with clients who have like amazing interest rates like this person at 1.99%. It would be great to know what the renovations are, what the upgrades are that the person's trying to do, just so that we can see, whether it makes sense to include that in this renovation, right? Because things are really expensive, so it may not be worth, pulling that extra equity out right now. But I mean, the what we would do in this situation is look at the weighted average cost of capital, right? So look at what the options are to borrow a second mortgage, a home equity loan, home equity line of credit, mixed in with like your existing balance that you have at 1.99%, and just kind of see like whether or not it makes sense for you to borrow that money in comparison to kind of like staying the path, right? And what the other options are to borrow that money, which outside of the equity in your home would be unsecured financing, right? Which really right now is like way more expensive than what you could possibly get.
Tough to even get approved for,
or robbing a bank.
So I would give us a call so we can break down the numbers for you. But I would say even with a home equity loan, if you were to consider borrowing that, like what would that be priced at today if you had to take a guess?
I mean, we'll
price it out right now.
We'll fall on 8%.
Sorry, 8%,
Yeah,
8 or 9%. Like not expensive. This is $1 million house with $400,000 mortgage, right?
So
listen, there is a very, very low chance that anything other than a home equity loan makes sense for this borrower.
Or a line of credit, yeah.
Yeah, or first option would be a line of credit. But yeah.
I got a question.
Oh,
what?
that totally threw you off. Right?
Yeah, that blew my mind.
It's totally allowed.
Yeah.
No,
So
yeah.
I mean, okay. March 1st, right? RSP deadline coming up.
It is.
I am an investor in the MIC. Can we all get a MIC update how it's doing? Because I have to, which I did already put some money for the RSP deadline, but I have to do some more to get my top up limit.
Mm-hmm.
Did you put it in the MIC?
Yeah.
Oh,
yeah.
The MIC has done so well over this period of time. It's always, we're very defensive, right? Like we went into a lot of first mortgages. I would say the only kind of thing I would fault us for is that we've been a little too conservative. Like we went into a lot of first mortgages. So the yield on the MIC isn't quite as high as I'd like it to be. I think that'll change over the coming months as we get paid back on some of the first mortgages and interest rates reset and recalibrate within the portfolio. But we're at 50% loan to value. We're in a ton of great equity position mortgages. We've got great borrowers. We continue to be kind of aligned with our borrowers on the exit strategies, which you guys see on a day-to-day basis with our files. Nothing's changed. And that kind of speaks to where we are within credit. Like we started off the show, we talked a little bit about Affirm and how Affirm's position within people's credit is at the end, right? Like it's the last stuff that they're worried about. Like the stuff that's like,
the bond me.
Like, listen, high risk car loans and, these buy here, pay here loans. Like these loans are high risk. They're the canary in the coal mine. They will default first. Cannect sits right either in first position or right behind a first mortgage. And we are extremely aware of the real estate we're lending on. We're extremely aware of the values. And more than that, we're partnering with our borrowers. So combining those mandates that we have when we deploy capital is a real recipe for success. So, I mean, listen, I'm topping my RSPs up the same way. A lot of people, like it's funny, right? Like we're having inflow of capital right now over this period of time, which is very rare in this space, right? Like you hear these stories about like Blackstone has a REIT and they're faced with tons of redemptions, or Romspin Capital is faced with tons of redemptions. We aren't the same type of fund as they are. You've heard a lot about these other funds, right? Like Romspin or Blackstone, where these massive funds with billions of dollars in it that were forced to deploy it into a whole bunch of different buildings or developments. They're forced to prevent anyone from redeeming and go in and realize on the investments. Well, just by nature of the way Cannect operates, we won't suffer that level of drop in the value of the assets we're lending against to ever impact our loan, because we're giving so much of a buffer between the amount that we're lending and the value of the property. So even if it does drop, we're still covered by the amount of equity. But more importantly, we're partnered with the borrower to get an exit. We're partnered with the borrower to get out of the loan together with the borrower by helping the borrower get better at whatever it is that was deficient in the loan in order to exit it. So, listen, I wish the MIC returned a little more right now. I think we're like close to 9%. I think we'll probably be, 10 or 11 by the middle of the year. But again, I should like kind of preface that with like past performance is not indicative
of
future returns. And that like whatever, I don't know whatever the stuff is that you need to say for the OST.
We'll put it on the bottom of the screen.
Sure, great. It always makes me nervous. But like, listen, I have I have a lot invested in our mortgage fund, and I'm so happy that it's there and that it's not anywhere else. Like the S&P, I don't know what it closed the day at, but it was probably above 4,000. Consensus is that based on what earnings are coming out and the multiple that the S&P should trade on earnings, that S&P doesn't belong at 4,000.
Right.
Belongs closer to 3,500. So can you imagine, right? Like if you're invested in mutual funds right now or a basket of companies that you believe to be blue chip, dividend paying stocks, those are on the S&P. And those have it's possible that those could drop 10 to 15% from here. The MIC's not going to drop 10% or 15% or 5% or 1% for that matter. Right? It's going to continue to pay you your dividends. It's going to continue to pay you your return. And that's something that I'm proud of. And I think that if you are considering where you're going to invest your money this RSP season, look no further than Cannect MIC.
Well, as a minority shareholder in a firm, I can definitely say that I appreciate Cannect's returns and the conservative approach, because it's been like a hedge against, other investments that I have that haven't been doing that great. But also just like in savings, right? Like it's a great kind of, for lack of a better expression, like set it and forget it.
Yeah.
I don't have to worry about the statements, looking at it to track. I don't open my iPhone to look at my widgets to see like, oh gosh.
How much did you lose in a firm today? Phil's got a firm.
Oh, you also have it.
I
told him to buy it.
At like $150?
Yeah.
Jumped in there and yeah.
Wow. Yo-yos.
So yeah, connected.
Hey, you guys ride or die with that thing now, right?
No, I'm going to zero.
I'm dollar cost averaging down so I can get out at something decent.
Oh, you're buying a little more and stuff?
I'm going to wait for it to tank a little bit more and then
it's like $12 right now.
Get myself out of there. I don't know if that's the right approach. I don't know what I'm doing. I know one thing is for sure is that's not the same decision.
I worry about that dollar cost averaging down move.
Yeah?
Yes. In this case, I would look at the loan book. I'd look at if they've secured financing to take their loan book. They may I don't follow the company.
Why don't you look into it for us?
Man, I'm telling you what to look for. Look into it yourselves. But this is what I'd be worried about. If they can't make new loans because their capital stack has changed, the amount of money they have and the cost of that money, if that runs out, these companies aren't profitable. They burn money. So this company will likely continue to burn money, but it will now burn money at a faster rate because the cost of the funds that they're using has increased and the amount of money that they can lend has decreased. So they can't make as many loans and the loans aren't as profitable and they were losing money before. They're just going to lose more money going forward.
Well, it sounds like I'm selling.
Listen, I don't know. You got to ask the questions of you can ask the company these questions too. You know that, right? You can
start the conversation.
Write an email.
Bring it full circle.
For me, the good thing is I don't have a lot invested in it, so it's not really that big of a huge concern. I'm not losing sleep over it, right? Mm-hmm. And either way, as I was saying before, I like the fact that it's not the same type of decision that I have to make where it's in a Connect. This is an firm, right? You got to ask the same questions, obviously, right? Make sure your investment is secure. DYOR, whatever. Do your own research, right? But I mean, I being in the industry, have more knowledge of what we do, how we lend. So I know, this is more secure. But I know, I can sleep easier at night knowing where most of my money is parked.
All right. I think that brings us to the end of the closing of a chapter. Today we had our head of underwriting, Phil Edwards, here. Phil's amazing. If you have the pleasure to have Phil assigned to one of your files, I mean, it's a good as deal as done, I would say. Yeah. So thank you very much. And I'll see you guys next week. Well, maybe not you, but I'll see you again soon.
You never know.
Yeah.
Maybe it'll just be me and Phil here next week.
I'd be okay with that. I'd be watching from the crowd. Yeah.
Well, if you guys want me back, I'm always available.
But we didn't say that. We didn't say that.
I love it. I love it. Okay, bye guys.
Bye.